Welcome to New Home Insights, the podcast from John Burns Research and Consulting. I'm your host, Dean Wehrli. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is Dean Wehrli with the New Home Insights podcast. John Burns Research and Consulting does a lot of the rental market. We keep tabs on the rental market pretty closely. We do a ton of consulting work in that sector as well. You might not know from the name of the podcast, New Home Insights, but I like to delve into the rental market as frequently as possible as well. So we're going to do that today. To help us with that, we have a couple folks here at John Burns Research and Consulting. We have Chris Nebenzahl. He's a vice president of rental research. So he is rental all day, every day. That's what he does. And we have Zak Nyberg. He's a vice president on the consulting side. He's based in Florida. He's been doing rental studies for a lot more years than he might look, because he looks like he's 20 and I look like I'm Mel Brooks playing Moses in History of the World Part 1. So, which I'm kind of angry at, Zak, by the way, FYI. How you guys doing?
Great, dude.
Good. Thanks for having us.
Chris, let's do this. Let's have you guys just give a quick little self-intro for yourselves, and then we'll go right to the meat of the market. By the way, listeners, we're going to cover a lot here. We're going to cover both apartments, BTR, but we're going to take a deep dive in a lot of parts of the rental market. So hope you enjoy. Chris, go ahead.
Great. Well, thanks for having me, Dean. Excited to be talking with you today about the rental market. As you mentioned, I'm rental research all day, every day. I've got about 10 years of experience in the rental research world, working with firms Yardi and Radix and a number of other rental research providers. And I've been with John Burns for about a year now.
Hey, everyone. My name is Zak. As Dean mentioned, I'm a vice president based in our Florida office here. On the consulting side of our business, we kind of touched all things housing, but I spend most of my time on the rental side of the business. So mostly helping apartment developers and their financing partners plan out new rental developments, being build to rent, apartments, or as we'll touch on in a little bit, how these products are starting to kind of blend together and just become rental communities.
Right on. Well, thanks, guys. So I want to start off actually with something the company did recently. We had a rental market summit. It was on Zoom. We had almost 300 folks. We had some amazing panelists. And we're going to kind of go over, just hit the highlights. We'll get into the meat, I swear, in just a couple of minutes. We'll just kind of hit the highlights from that, because it was pretty insightful. It was pretty interesting. It's pretty eye-opening from some of the responses from some of the panelists. So Chris, you're mostly going to have you were organized that and a huge part of that. Let's just start with kind of the idea of are there market kind of bears and bulls out there? Which way is that trending? Who's dominating right now in terms of the rental space?
Absolutely, yeah. And I would say the main theme of our rental communities summit, the main theme that we're seeing across the rental market right now is one of optimism. The rental market, especially the institutional rental market, BTR, multifamily, we really went into our housing recession about 2 years ago. I know the for sale side is slowing now, but the rental side has really been looking for a bottom. And I think we've found that bottom really throughout the calendar year 2025 here. And we're starting to see some optimism. We're starting to see some green shoots. And that was really the sentiment of our rental communities summit as well. One of the poll questions that John led with was, are you bullish, neutral, or bearish? And it was really interesting for me. About 60% of the attendees said they were neutral, so somewhere in the middle. But of the 40% that said they were either bearish or bullish, 32% of the attendees were bullish, 8% were bearish. So if you just look at the folks who are up or down on the rental market, it's about a 4-to-1 ratio. Who's optimistic, who's bullish, compared to about 8% of the whole attendee group that was bearish. Still
a lot of neutral, wait and see kind of an attitude, but that's better than a year ago and 2 years ago, and when we had all that, such a huge stream of supply. How about in just terms of the general market? Did folks see the market as being on the upswing, as some lift to prices and occupancies?
Absolutely. And I think the main driver of the rental recession or the slowdown that we saw was just how much supply we've added to the market, both BTR and multifamily over the past couple of years. We're certainly past that supply peak, and we're absorbing units at a very, very strong clip. maybe not back as strong as we were absorbing in 2021 when there was stimulus money flying around and everyone was looking for their own space, and absorption was at an all-time high. But we're really absorbing units at a very, very strong clip right now. Part of that is due to the affordability challenges on the for sale market. We know it's about twice as expensive on a monthly basis to own a home as it is to rent the average apartment in the US. So a lot of the demand is moving to the rental market and really keeping the rental market afloat. We're starting to see occupancies level out. Rents are starting to pick up, even in some markets that have been oversupplied across the Sun Belt.
I want to ask you a real quick question on markets, but first, Zach, are you noticing a little uptick in your rental business? Because we are a good bellwether, actually, as our consulting side especially is a good bellwether for how optimistic folks are in whatever sector. Are you seeing any kind of lift in the amount of rental work that you're doing?
Yeah, we really have. Just in the last 6 to 9 months, a lot of the developers in particular are becoming more and more optimistic about the future, especially as it relates to planning and developing new rental communities right now. Really, as Chris kind of mentioned, they're kind of seeing that kind of supply wave come to an end here. Yeah. And because of that, now is the time that they're thinking about planning out their new communities that might break ground in 2026, begin leasing in 27, and really trying to time the market out. Just to speak on the number of folks who responded neutral to that poll at our rental community summit there, I think a lot of that comes from the debt and equity side of the business. They are certainly a little bit more in the wait and see camp right now. And a lot of the work that we're doing with the developers is trying to tell that story on a market by market, sub-market by sub-market basis to really understand how these things are going to play out over the next 2 to 3 years.
And Chris, wasn't that something that really was pretty clear at the end of our rental summit event, is that what market you're in has a big impact right now?
Absolutely, Dean. And we can look at the national numbers, we can look nationwide and say things are balancing out, but really it's a tale of two markets. One of them being the Sun Belt, Southeast Texas, Southwest, the other being the Mid-Atlantic, Northeast, Midwest, and West Coast. Mm-hmm. Those markets, the latter markets that I mentioned, performing much better, did not have the supply challenges that the Sun Belt had, and have really kind of coasted through this slowdown and are still performing well. It's the Sun Belt markets that had the big run up during COVID, had the big fall off when supply peaked, and are now starting to gain their footing again.
And we'll take a deeper dive into a lot of these things as we go along, a lot of these issues and these areas. Real quick, though, Chris, before we move on to sort of the first thing we're going to do is take a little deeper dive into the market. Any other takeaway from that event that you want to mention?
Yeah, I would say kind of the continuation of some trends. We heard from some operators that say centralization is continuing across multifamily and BTR, centralization of management. Innovation comes through property management, a lot of tech opportunities, but also just innovation within the way fees are handled in rents, and different strategies around driving rent growth, driving resident retention, and driving resident experience. Resident experience, is really kind of the key in multifamily right now. We've seen retention reach record highs from the REITs. We've seen that in our own data as well. So it's really focused on the resident experience. Are the amenities correct? Is the location correct? Is the demographic, is the product type meeting the resident where they're at? And so I think that continues, and that will continue through the next cycle.
Okay, so let's start. We're going to talk first about kind of a deeper dive into the market, where rents, occupancies, all the big stuff, but some other parts of that as well, a little bit more detail. So let's start with one thing, actually, Chris, that you mentioned, is that there is really a more optimism, isn't there? And that's based mainly on supply. So before we talk about sort of prices, let's talk about supply for a minute, can we? We're seeing the rear view of that massive wave of supply. Just briefly, Chris, we'll start with you. Give us a little background, a little history of how that supply went, where it is now, and maybe even where we forecast it going. Permits, completion starts, however we want to express it.
Sure. So again, going back to kind of the COVID time, 2020, 2021, we saw a massive run up in demand for housing, for sale, for rent. Households were forming very, very quickly. And that couples with a time when money and development financing was very cheap. We had a zero interest rate policy, and it was easy to make deals pencil, especially in the Sun Belt where a lot of folks were moving. And so the developers kind of rushed in. They were able to get projects permitted and zoned. And really the construction wave started in 2021, 2022, and kind of tailed off in 2023. That's when the majority of the starts started, or the starts really got going. The Fed raised rates quickly. That really put a damper on the development activity. And it coupled with a lot of that new supply starting to hit the market in 2023, 2024. When you get this rush of supply, demand was about the same. But as we know from Econ 101, supply comes in and demand stays the same, you're going to start to see prices drop. And that's when you saw rents start to fall in places like Austin and in Tampa and in Fort Myers and in Phoenix and Denver and Charlotte and a lot of these Sunbelt markets that saw so much in-migration. So again, we saw this big run up in rents that was followed by a large run up in development and supply that led to a slowdown in rents. And now, as you mentioned, we're in the rear view mirror. Those starts have slowed down significantly since about 2023. And now we're starting to see the deliveries slow down significantly because it takes about 6 to 8 quarters to build a multifamily project, depending on where you are and the product type. So
what kind of product? Before we turn to talk about price, I want to bring Zach in. Zach, I mean, weren't you you're based in Florida, but were you doing just tons of apartment studies? Did you ever see markets where you just had lots of new stuff, just a massive pipeline? Where are some markets where you just saw a huge pipeline of apartment supply and rental supply coming online?
Yeah, working in a lot of those Sunbelt markets that Chris mentioned. So areas like Tampa, Southwest Florida, and Fort Myers, the Carolinas, Charlotte, Raleigh, some pockets of Atlanta, and a couple of other smaller tertiary markets around the Southeast as well. Those were all areas that were really attractive in 2020, 2021, seeing record absorption at those times. And really, the supply caught up with that demand quite quickly and exceeded it in the short term over the last couple of years. But like Chris mentioned, the starts have really started to pull back in those areas. Demand has remained pretty steady Eddie. And as a result, we are starting to find kind of a floor in terms of occupancy rates and rent growth. And some of these areas are actually beginning to rebound.
Were there any places you remember from a study where you had just like literally whatever, 3, 4, 5, 6 active in lease up apartment projects going in some kind of concentrated area?
Yeah, one submarket in particular that we were doing a lot of work in was Wesley Chapel. It's kind of a northern suburb of the Tampa area, and about 30 minutes outside of the downtown major employment hubs there. Really commutable location, affordable compared to downtown. That was drawing a lot of folks to the area. So 2020, 2021, 2022, even, we were seeing 6, 8 projects in lease up. They were all doing pretty well, and most of them only needed to offer that kind of normal 1-month free rent concession at the time. But I will say, more recently, that concession activity in particular has spiked up.
Yeah, we'll talk about concessions in a minute. So let's talk about price though, generally. Chris, back to you. Give us a little brief, like near term, current, and maybe even give us a sense of what we project with respect to rental price change.
Yeah, and so this is kind of the confluence of that supply and demand. We've seen rent growth slow significantly from the mid double digits, mid teens in 2021, which is a historical anomaly. Typically, rents grow at about 2 to 4% per year, and we saw upwards of 10, 15% rent growth, even higher in certain markets back in 2021. That slowed down to about 0. It dipped negative at the national level ever so slightly. But now we're back to about 0 to 1% rent growth nationwide for this year. I expect that will recover again 2026, 2027 because of the supply slowdown and demand remaining steady. We do expect to see rent growth back in that normal range, about 1.5 to 2.5% range in 2026, 2027, with the opportunity for rents to grow even stronger, even faster, if that supply stays muted over the next couple of years.
Are we still up, though, pretty significantly from, say, pre-COVID? What you described was rapid price appreciation, pretty limited, flattish to slightly negative. So we are still relatively unaffordable compared to just a few years ago.
Yes, absolutely. And so if you were to look at kind of the compound annual growth rate going back 5 years or 6 years, we would be above that long-term average. Again, the last couple of years of flat rent growth has muted that acceleration. We're actually seeing rent-to-income ratios in really healthy places right now because there's been continued income growth for the past 2 or 3 years and really no rent growth. You look at markets like in Austin, and you've even seen continued income growth and negative rent growth, making it even more relatively affordable on that rent to income ratio.
Still, my sense is though we still have a ways to go if we want to get back to the affordability of, again, let's say late teens kind of a period.
We've got a certain distance to go.
Okay.
Again, when you look at the for sale market, though, the for sale market is so unaffordable and so cost prohibitive, it's really driving more folks to that rental market.
Okay. So the flip side, of course, of supply that we talked about is demand. And typically we measure that by absorption. So Zach, you mentioned a minute ago that absorption stayed pretty normal. I mean, even as supply waned, were you seeing the sense that no absorption did, at least for a while, start to wane, start to get hit?
I think there was a slight period in 2022, 2023, where a lot of folks on the for sale and the for rent side of the equation just kind of hit the brakes on making housing decisions. They're really staying in place. But more recently, like Chris mentioned earlier, demand has come back in a pretty strong way. And there's a couple of submarkets that I've worked in recently where on a trailing 4-quarter basis, absorption is at or even above those 2020, 2021 levels. So really strong demand on the apartment side in a lot of the areas that we're working in right now.
I'm going to come back to that in a second, Zach, and tie that in with concessions. But first, Chris, in terms of national numbers, are same story. We're seeing still pretty decent absorption levels, and as that supply wave continues to crest, it's getting pretty much a market equilibrium now.
Absolutely, and I would say that absorption has been the one saving grace for the rental market the past couple of years with all this supply coming online. Concessions have been elevated, and that has helped on the cost side of things. But you look at some of the markets where we're seeing the most absorption, even though they're the hardest hit, the Nashvilles, the Austins, the Charlottes, the Florida markets that Zach mentioned, we're still seeing really, really strong absorption. So even though we're not quite seeing the rent growth yet, occupancy is still below their long-term averages. If not for the strong demand, those occupancy numbers would be well below. The rent growth would be even softer.
But a lot of that absorption is coming from increased concessions, right? So is that fair to say we see more of the concessions in stabilized apartment complexes, don't we? And we see maybe a little heightened concessions more than that typical 1 month when an apartment complex is in lease up. Are you seeing that?
We do. You're right. Concessions have certainly been a huge component of the market and the lease up process over the past couple of years. But really, demand is driven by fundamentals, by job growth, by migration. And so certainly property managers and owners will implement concessions in order to lease up a property. And to your point, even some stabilized properties are going in the concession route. Yeah. But again, the fundamentals of the economy remain fairly strong. I think we've seen some slowdown in the employment markets, some warning signs of a softer economy, but we're still adding jobs. We're still seeing migration to the Southeast, Southwest, and that's really what's driving a lot of the absorption.
You mentioned retention, and retention has become so critical. The modern model for the apartment sector is keep those folks there. It's a cost and a pain point if the churn rate you want to be as low as possible. Are we seeing a rise in the delta between what new lease ups are paying and what those retained tenants are paying?
We are. And that gain to lease gap or that gain to lease spread is becoming of growing importance, I would say, to the property managers. When your renewal rents are higher than your new lease rents, if that gap grows too wide, then you'll see people say, you know what? I could go down the street and rent an apartment for $100 less a month, or they're giving me 1 or 2 months free. Mm-hmm. I'll move out. We're in this interesting balance though right now where, as you mentioned, the property owners and the property managers are focused on retention. They don't want to have to pay turn costs, vacancy loss, and potentially even rent that unit at a lower price. The resident though, they are also quite happy if they say don't get a rent increase or don't get a massive renewal rent increase, they don't have to pay for a moving company. They don't have to switch their address. They don't have to tell their mother and brother and everybody else that they're moving, and get help and get help moving and all that stuff. So I would say we're right kind of in this sweet spot. But if that gain to lease gap really widens, you will start to see apartment renters and BTR renters to an extent. But really the apartment folks will say, sure, I'll pack up my studio or my one bed for the opportunity to save $100-$150 a month. Absolutely.
It is easier. You just don't want to have your new neighbor be somebody who likes really terrible music. Zach, how about concessions though? Were you seeing some like just nutty concessions? Some, I don't know, 2 month, 3 months off, or even just kind of some really inventive or kind of qualitatively off the wall kind of things when things were a little worse off?
Yeah, well, just on the elevated concessions note, a lot of the markets that I'm working in right now, they are still relatively high supply in terms of having a handful of projects that are in lease up right now. And it's certainly not uncommon for all of those communities in lease up to be offering at least 2 months of free rent. In certain cases, if that's not enough, they'll be willing to throw out some more creative things like gift cards, free TV is a raffle to win a golf cart or something like that. And those are all seemingly pretty effective. But then in some of those markets as well, as you mentioned earlier, Dean, some of those stabilized properties are having to reintroduce concessions, maybe not to the same level that those lease-up properties are offering, but certainly they are trying to maintain their attractiveness and their competitiveness in the market relative to those new competitors down the block who are offering something shiny and brand new for probably a lower effective rent than your property that you're at right now. And just to speak on the kind of the gap of the renewals versus new rents, I was one of those apartment renters who was chasing the deal, chasing the concession, willing to move every single year for the past few years. But literally, Chris kind of hit the nail on the head that gap has shrunk a little bit as those concessions have burned off the new properties and the renewal rate increases have dialed down a little bit. I'm more than willing to accept a minor rent bump to avoid that avoid the inconvenience of moving.
Yeah. Honestly, we've always, in demand analysis, you always want to look at what new rental demand there might be, the generation of new rental demand in a given market. But for a newly leasing up apartment complex, the place they're going to get most of their tenants are existing older apartment complexes from around them. Chris, just your general sense, give us your maybe forward-looking general sense of where you see the rental market going in the next year or so. Don't go too far out.
Yeah, absolutely. I'm optimistic, but I would say cautiously optimistic. Again, I see a challenging for sale environment that's going to drive more and more share of household formation to the rental market. But I also see some economic headwinds that we might see. We might continue to see a slowing employment market. We might continue to see fewer and fewer households being formed, perhaps because of affordability, perhaps because of economic uncertainty. So I do think the rental market will take the lion's share of new household formation. I do expect the rental market to outperform the for sale market, but I don't think we're off to the races. I don't think we'll see 2021 growth. In fact, I don't think we'll see that ever. I think that was a really unique combination of factors that led to astronomic rent growth. But I do think we're in for more of a normal rental period, and the rental market has always been slow and steady and boring, and you get 3% rent growth, and that's a good market.
And there's a lot of talk about immigration policies, especially in the for sale world, and their immigrants are a very, very important part of the rental world. But for the most part, tell me if I'm wrong, but I don't think we expect that to hit the new rental world, the Class A brand new complexes, because given the price niches there. Is that fair?
That's right. And I would say most of the immigrant population, or at least the immigrant population that's crossed the southern border, would be renters, but they wouldn't be institutional grade renters that we're looking at in BTR and professionally managed apartment communities. I see the challenges with immigration having a deeper impact on the construction side of things. Can we start the projects that we need to in order to maintain the demand with a limited construction labor force? That I think is a major concern as I look over the next couple of years.
And given the decrease in supply, that potential hiccup down the road hasn't been felt as much. But if we start to ratchet up supply again, as in the hopefully not too distant future, we might feel that depending on what the policies are then. We'll see. Let's talk about demand and supply a little bit more in terms of, I guess, the motivators for that. We talk about how critical absorption is and how absorption has been surprisingly pretty resilient here, even as the rental market weakened. Home ownership, Zach, you mentioned that a minute ago. Home ownership. Do you see a lot of the rental studies that you do, and you do a lot of for sale work as well? Do you see that dynamic where folks are sort of quote unquote pushed into the rental market because of the expenses of home ownership right now, especially now with high mortgage rates?
Yeah, certainly that cost to own versus rent gap is near historic highs in most markets.
Mm-hmm.
And that certainly is encouraging folks who may be aging out of a, studio or one bedroom apartment rental. Maybe they're a hopeful kind of homeowner one day, but they simply can't afford it right now. And I think that's one of the reasons why a lot of folks who are moving out of apartments aren't necessarily going into the home ownership world, the for sale side of things. They're now transitioning into single family rentals or build to rent products.
Do you see any apartment complexes that are they actually literally sort of motivating their potential tenants or advertising on the fact that, hey, it's, you can't afford a home, come here and rent? Do you ever see a kind of explicit connection from apartment complexes on that?
I haven't seen anything explicitly advertised, but certainly in some of those conversations with leasing agents, that is a point that comes up quite often from their prospective renters or their current tenants. And I think that's one of the reasons why renewal rates are so high right now, and same with absorption on new supply that's being delivered.
Okay, Chris, are you seeing nationally? Is that's something that's happening right now, that you see the expenses of homeownership are pushing more folks into the rental world? Is that part of why our absorption is so decent right now?
Yeah, I think that's contributing a lot to the absorption numbers. I think it's also contributing a lot to the retention numbers, where typically you have a certain percentage of renters move out every year to buy those homes. Okay. It's more cost prohibitive to do that. And it's more cost prohibitive in the locations that they want. Okay. I think that's a critical piece here, that we're starting to see builders or even the resale market. It's affordable in certain areas of a market, but they're farther out. And so this idea of renter by choice, renter by necessity, I know we're going to talk about that in a little bit here, Dean, but it's a bit of a blend. If I want to be in school district A, or if I want to be in walking distance to my office, or if I want to be in a certain area, you're seeing more demand for rentals in those areas because it is cost prohibitive to buy in some of those areas, even though folks might be able to be approved or get a mortgage in farther out areas of their MSA.
Now, Chris, before we started recording, Chris said, "Hey, you don't throw us any curveballs, Dean?" Because I give him an idea of the topics in the outline that we're going to talk about, and I said, "Of course I am." And he said, "Bring it on." And he called me a name that I'm not going to repeat here on a family show like this is. But I'm going to throw you a curveball, and both of you actually. What do you think of the senior 55 plus, 65 plus market rate apartment sector? To me, I'm not gonna lie, it seems a little bit dicey given the home ownership dynamics of that kind of an age group. I mean, are you seeing more, Zach, in your studies, or Chris, nationally, a lot of or more of that kind of market rate apartment projects positioned as senior rentals?
Yeah, I'll take that because I am based in Florida and we see a lot of those residents down here. I think just naturally, some of the areas in Florida do attract a heavy retiree population, and they certainly kind of fall into that renter by choice category. Okay. Oftentimes, these folks have owned a home, currently own a home, and they are choosing to kind of cash out and go for that rental lifestyle because of the maintenance-free living, because of the convenience of having the amenities. And then one other piece of that equation is just kind of connectivity in the sense of community that you get in a Class A kind of professionally managed communities. Lots of projects that I do, even if they're not a age-restricted 55 plus community, they will host weekly events in their kind of leasing offices or clubhouses that are definitely targeted towards those kind of older renters.
Mhm.
Things like a paint and sip class, or
Yeah.
food trucks coming by the community. Those are all great things that attract those kinds of people, and it gives them kind of that sense of community, some of that socialization that they might not be getting through their family that may live far away, or through work if they're retired. It's a really great way to bring people together.
How about you, Chris? Are you seeing more of that? Are there any statistics that can track that?
Yeah, I wouldn't say necessarily senior specific, but we are
Okay.
seeing that baby boom cohort as a huge driver of demand for the BTR sector, especially. They want to be close to their grandkids. They realize that their kids aren't moving back to where they grew up. And so the grandparents
Mhm.
now have to follow the kids. And as Zach mentioned, they want that maintenance free lifestyle. They still may want 2 or 3 bedrooms, a dining room so they can host and have people over. They're not kind of that target urban high-rise apartment renter. But absolutely, we're seeing huge demand from the baby boomers go into the BTR communities, and it's not just Florida; it's the Carolinas, it's Nashville, it's
Okay.
Phoenix, it's Austin. Baby boomers are a huge
Yeah.
demand driver for the BTR segment, and as Zach mentioned, the amenities. I mean, it seems like everyone wants to play pickleball these days, and
Yeah.
that is kind of the hot amenity that
That's
millennials and baby
trying out.
boomers can play together.
Yeah, exactly. And what you described, both of you, Chris and Zach, is that that's kind of the same. That social interaction is the same draw that for sale age qualified communities are going for as well. It's just in a rental world. I'm just wondering why they're not more likely. Is there a reason they're rather rent than buy in a for sale place? Is it just the even lower maintenance kind of lifestyle, or just the social interaction is so close and so constant? It's just a better lifestyle for them, I'm guessing.
I think it's that to an extent, but also the lock and leave idea.
Yeah, that's
I'm
true.
downsizing. I don't need to mow my lawn. I don't need to shovel snow. I
Yeah,
don't need to maintain anything. I'm going to lock my door and go on a cruise for 3 weeks, and then I'm
yeah.
going to go visit my other grandkids over here, and then I'm going to go back, to my original home and spend some time there. I think that's a huge driver on the BTR side.
And it gives you an access to your nest egg because, like Zach said, they're going to cash out, and now they're renting. They're just paying that monthly rent. They sold their home and they're cashed out, and they are going to be in Greece and Cabo San Lucas a fair amount of the time. Let's talk about BTR then. We do a ton of build to rent work. That part of the rental world seems to be a little bit more stable here than apartments, at least for a time when the market was maybe at its worst. Um, do you see BTR, Chris, the build to rent sector, continue to kind of gain market share relative to the rest of the rental sector?
I do. And I think that's driven heavily by the demographics that we're seeing. Demographics, they say it's the glacial science. It's a very slow but strong moving force. And what we're seeing right now, not only the baby boomers that I just talked about, but the millennials. Millennials are aging. They're wanting to have kids. They're wanting to get married. There's been plenty of research both here at John Burns and elsewhere about the major milestones in life taking place later. You couple that with a challenging for sale market, and those folks who finally do want to get married and do want to have kids and do want to be in a good school district and do want to have the backyard
Mm-hmm.
and have a place for the kids to run around and the dog and everything, they're moving into those BTR communities as well. So you kind of have this two-sided double-edged sword or barbell or however you want to describe it of demand that's driving into this BTR market. And you're seeing some major institutional players follow. You're seeing the JP Morgans and the Blackstones of the world being very active in the BTR space. And it's taking a larger and larger market share of construction of all multifamily each year. So I'm very optimistic that BTR will continue to grow moving forward.
You mentioned location. Zach, you mentioned location too early when you talk about apartment complexes north in a suburb north of Tampa. Is location just hugely important for BTR? And is the ability to locate in, like Chris said, kind of a better school district, kind of a quote unquote better neighborhood, is that a key part of the success of BTRs? Are you seeing most BTR stuff gravitate towards those really nice locations where home ownership would be pretty cost prohibitive?
Yeah, I think one of the things that we've seen with some of our clients who are a little bit more flexible is that they're willing to kind of modify their product type at a site to kind of match the demographics or the desirability of a certain location. So if you're in an area that has really high home prices, really great school districts, and you think that that's going to attract a lot of families, those folks are then choosing to develop those build to rent townhomes or fully single family detached communities. So you can provide that single family lifestyle with the garage, with the space for the kids, your dog, the fenced in yard, all of that great stuff. And then on the flip side, if you're kind of in a more kind of tertiary market, maybe an area that's not in a great school district, but it's still a nice accessible site, that's where we're seeing a little bit more of those kind of horizontal apartment, cottage style communities or the row homes coming in there that are going to attract those younger households without kids or the empty nesters and retirees who also don't have school age children.
Yeah, I think we're seeing the maturation, the continuing maturation of the BTR sector, where it's getting more and more, frankly, like kind of like the for sale sector, where you hit density, hit higher density levels in those prime locations with the more expensive land. Are you seeing, either one of you, Chris or Zach, those those BTR almost segmented communities where you've seen multiple BTR communities within one space, not just the kind of the classic little standalone BTR community? Are you seeing that?
Absolutely. And one of the trends we've seen is the mixed community, as we call it, where it's two or more product types in a given BTR community. That's been growing in popularity tremendously. And Dean, just going back to the Rental Communities Summit from last week, on your panel, a lot of the discussion was about matching location with product type. And so if it skews more suburban, maybe you'll have a higher concentration of those single family detached homes, but still have some townhomes in that community to kind of blend that demographic, blend that potential renter. To Zach's point, if it's more urban, maybe you'll see horizontal apartments and a garden style apartment, or horizontal apartments and townhomes. The idea of mixing the communities with different product types makes a ton of sense right now and is really sought after by the developers, because it allows you to kind of balance out your lease up. Single family detached homes lease a lot slower than horizontal apartments, but their residents stay a lot longer as well. So you can kind of balance your lease up, balance your cash flow by having that mixed community of multiple product types.
And are you seeing increases in density in the BTR world? Zach, as you do BTR studies, I know I am. I'm seeing much more stuff. The whole sector kind of came out of SFR, and that was detached homes and just building, renting homes that were frankly built as for sale homes. As BTR matures, are you seeing a lot more density, a little more density?
Yes, we are seeing a lot of big push for density in the recent years here. I think part of it is related to affordability, despite the fact that build to rent housing is typically more affordable than for sale housing in those same areas. There is still a rent ceiling that a lot of developers are very well aware of, and they really can't afford, with the rise in construction costs, land costs over the last couple of years, to develop the homes that they were 5 years ago with the rents that they're able to achieve today and still hit that same kind of margin to need for those deals to pencil. So really, particularly what we're seeing is a shrinkage of the home sizes, really going down from a 1,600 square foot 3-bedroom house to a 1,300 or 1,400 square foot house, going from a 22-foot wide townhome that might have a 2-car garage down to a 16 or 18 foot townhome that has a 1-car garage. Really anything that they could do to, one, increase the density in the community, but then B, deliver a product at a lower final rent for those tenants.
That's a great point, because I remember early on, the first BTR studies and even SFR studies that we did, you quickly realized that there was kind of a diminishing return on rental rates. Chris, is there any rule of thumb when you think about that price ceiling for rental for BTR world that Zach just mentioned? That what does it relate to? Is it related to the apartment market, which, even with the decrease in sizes in the BTR world, they're still going to be much bigger than most apartments are? Is it related to local mom and pop SFR in that same market? Or is it related to homeownership above them? What is causing that kind of ceiling effect?
I think it's a number of those factors that you mentioned, Dean. Certainly on the SFR side, those are the scattered site SFR, I should say. Those are not amenitized. Many of them are rented by mom and pop, although there is some institutional ownership and management there. So that on-site maintenance is seen as very valuable for BTR tenants. Again, that ability to have that social community, have those amenities, I think helps drive rents, but it does have a ceiling. You're not going to pay so much more than you could in a single family detached scattered site home. And the same thing with the for sale market. Again, we've talked a lot about the cost prohibitiveness of the for sale market, but if mortgage rates come down, if prices come down, if builder incentives remain high, you will start to see folks, vacate BTR communities for the for sale market.
Yeah.
But right now we're just not seeing that.
Okay. Let's talk about capital a little bit in the BTR world. Isn't most capital in the BTR world is you see a lot of it that is it hedging right now? Is it still a little nervous? Obviously interest rates are still pretty darn high. Are you seeing any kind of unfreezing of capital in this portion of the market?
I would say capital in general is becoming friendlier to the BTR space. Again, as you mentioned, the BTR, institutional BTR is really only about 10 years old, maybe a little bit older in certain markets. So institutional capital, I think, was slow to accept BTR. But again, going back to our rental community summit last week, the cap rate spreads are basically non-existent between BTR and multifamily now.
Okay.
It's deal by deal, but there's a lot of interest in BTR. There's a lot of institutional capital looking at the space. Again, interest rates being where they are, I think folks are still on the sideline. But if we see softening of rates, or if we see fundamentals, if we see rent and occupancy pick up, and the likelihood of strong growth over the next 2 to 3 to 4 years, I think there's plenty of capital on the sidelines ready to move into that space.
That was my next question, actually, is are you seeing that new capital enter the space, or foreign capital enter this space, looking for that safer American investment?
Yeah, that's an interesting question. And going back to our panel on capital last week, we are starting to see some interest from foreign capital. I think we're in a different situation than we were, say, 6 months ago, 8 months ago, when the TINA trade, there is no alternative to the US. Well, 2, 3, 4 months ago, I think a lot of the foreign capital said, hey, let's pause for a minute. There might be an alternative to the US with a lot of geopolitical uncertainty, a lot of economic uncertainty. I think that will thaw over time, that cooling will thaw over time. I do see a lot of interest from foreign capital, but I think it's going to take a while to get off the sidelines.
And will it require, I imagine, kind of an all of the above menu in terms of some softening interest rates, some lift in prices, maybe even some softening in hard costs? Is it going to take kind of all of those things to make these deals start to pencil again?
I think it will.
Let's go to amenities. Zach, I'm going to lead with you here. What's hot? What's not? Is there any kind of neat amenities you've seen on the horizon in some of the apartment complexes you've looked at?
Yeah, so I think we've mentioned a couple of them here already. Most of the new communities that are being developed typically provide that kind of Class A clubhouse feel. Lots of the business centers are still important, even with some of those return to office calls. Folks are still working in a hybrid situation a lot of the times. And particularly for the apartments, those co-working spaces are becoming more and more used. A lot of apartments have had them for quite some time, but they're really underutilized. They're really not designed in a way that actually allows people to work and go on calls like this. But now we're starting to see Zoom rooms introduced, full-on conference rooms being introduced into those types of amenities, and getting reports that they are, some of the top used amenities in those kind of complexes. I still think that fitness centers, pools, dog parks are important to a lot of folks. Once again, if they're done right, then they get used a lot. Seems like a lot of folks want to have them, but then they don't end up using them if they're not designed properly. One really cool thing that I've seen recently, this is at a luxury community in Southwest Florida. They had like a self-service mini mart, but it wasn't like a mini mart for groceries, snacks, things like that. It was more for everyday kind of household items that you might not have but need. So a couple of examples, they had like a vacuum that you could rent, or a drill that you could rent. So you could go and hang a TV in your apartment on kind of an hourly rate. And it was all done through their app, where you kind of just self-service, check out those items for a couple of hours and then go and return them. So one of the things that I think is related to that is a shift from more of those physical amenities, which I think we're starting to get tapped out on in terms of what we can offer to folks, and shifting more towards more services and conveniences that just make people's lives better.
That concierge kind of lifestyle. Again, though, that comes with a price, though. That's going to be some pretty class A plus kind of scenarios and complexes, isn't it?
Yeah, at that one community in Southwest Florida, that was brand new, just started leasing up 2 or 3 months ago, and was positioned well above the comps in the submarket there.
That's a really cool idea, especially if you're a little bit distant from retail. I know you talked about kind of services, drills and vacuums, but having little things that you don't think about that you would, run to the store real quick, but you can't run to the store real quick. Having kind of access to that would be an interesting thing. I was interested when you said about the office space and the co-working. Are you seeing that in the apartment? Like they're doing little alcoves, like you mentioned, Zoom rooms are actually in the units themselves. Are you seeing them be able to accommodate folks who I think forever, even if it's 4 days a week into the office, that still means you're 1 day a week, if not more, at home. Are you seeing that within the units themselves?
Yeah, I'm seeing it both ways. Some developers are taking the approach of building in little workstations into the units themselves. I think the much more common approach is to put it into the amenity center and have a dedicated kind of co-working office space there. Really, once again, that helps the developers deliver a slightly smaller unit that's slightly more affordable, kind of spread that out to the people who are actually going to use it.
Are you seeing any people? It's expensive, but if you're going to home office, say 2 days a week, they're getting that extra bedroom. It's a couple; they only need one bedroom, but they're getting a two for that reason.
Yeah, we actually have got a lot of reports that some high income young singles and then young couples in particular are electing to go for, the smallest 2-bedroom unit versus the largest 1-bedroom unit in complexes. And really, just like you said, especially when you combine that with the 1 to 2 month free rent concession that a lot of folks are getting when they sign that new lease, it's not that big of a step up for a dual income household to go and get that extra space to typically be used for an office, especially if people are working at home a couple days a week, but then just to have that extra space for guests to come visit and host.
Yeah, it kind of gives it is expensive though, right? Because that delta from 1 and a 2 is pretty steep. How about in terms of product overall, Chris? We talked a little about product at that rental summit that we talked about a couple of times here. Do you remember anything from that? What are some interesting product innovations that might be going on, or even product innovations that aren't happening, like for instance, modular and offsite? Do you see that kind of scenario becoming more prominent in the apartment world, widely defined?
Yeah,
I think rental world.
I think the modular discussion has been thrown around for almost a decade now, and there have been companies that have tried it and failed, and on the construction side have gone out of business. I think a lot of developers have at least checked it out, but no one seems to be really driving forward on a modular design. There are certain firms that are going to light gauge steel in certain instances. Mass timber has become an interesting kind of niche development product in the multifamily space, in the high-rise multifamily space. So there is some innovation. That the modular, the panelization has not really taken off yet. But I think not just the products and the building materials, but it's really all about kind of differentiating your community and finding that special whatever, if it's the location, if it's the building type, if it's the amenity. I mean, I think a lot of people are still driving towards that experiential amenity. Dean, you'll love this one. I was touring an apartment not far from our headquarters in Irvine that had a podcast room in the apartment, and that was a part of the amenity package.
Did you hear me gasp just now? That would be phenomenal.
I figure you might want to relocate just for that, that opportunity. Or there's a community here in Denver that I toured that has a bar. It just exclusively for its
IPAs.
residents.
I'm assuming it's only IPAs and only IPAs. And you have to have actually crumbs of food in your beard when you walk in, or can you get that during your stay there?
I toured it during the day, so the bar wasn't incredibly packed. But I'll have to check back on that if I go over in the evening sometime.
What's the number one community amenity though in Denver apartments? I think we both know what that is.
In terms of community amenities, I would say it's all about bringing the community together. Pools are still popular. Some community gardens
I'm
are
talking about
popping
Denver
up.
specifically, Chris. Denver specifically. Don't sugarcoat it.
I know where you're trying to go with this, Dean. The community garden.
Let's be honest. You can call it a community garden if you want, but we know what kind of plants are being grown there. It's Denver, for God's sake. So anything else in terms of product that you think might be a change going forward in the rental world?
Yeah, I think we'll continue to see this trend toward BTR, the trend toward garden apartment. Okay. The high rise is not dead. I think, in fact, with the return to office, you're seeing more interest in the high rise. But if you look at the construction numbers, the suburban areas, the lower density is certainly winning the day today.
Okay. How about, let's end with this. How about both of you just give me a little key takeaway that you think you want to leave the listeners with as you wrap the show. Zach, why don't you start?
Yeah, well, hopefully I can leave everybody on a note of optimism here, because I do believe that the darkest day on the rental side of housing are kind of behind us, in the rearview mirror for most markets at least. So when you think about it, the long-term kind of demographics that we talked about are still strong. The economic fundamentals, little uncertain over the last couple of months here, but overall, especially when you think about the U.S. in context of the entire global economy here, we are in a relative position of strength. So we have the long-term demographic tailwinds supporting rental housing. We have the solid economic fundamentals. And as we kind of touched on earlier, that supply wave that has been causing a little bit of stress or even distress in certain markets and submarkets across the country is starting to move into the rear view for all of us looking right now. So when you're thinking about planning a new rental development today that might not break ground until 2026 and begin leasing until 2027, the market is going to look a lot different 2 years from now than it does currently. I think we touched on a couple of the things, like we expect rent growth to return. We expect the supply pipeline to slow down pretty significantly. And we expect those demand drivers to continue pushing towards rental housing. So really, in my opinion, right now is the time to get prepared and start planning for that next wave of development. And really what we do all day on the consulting side here is help those folks identify the right markets, the right product types, and the right timing to make those projects successful.
And I think, Zach, that's fair too. A lot of folks in this business, especially like developer side, are optimistic and have to be optimistic. You have to kind of be a glass half full kind of person. We need to be not a glass half full, but not a glass half empty. A glass will tell you exactly what the level of the water of that glass is. And I think you're being absolutely honest and accurate in terms of, we do see some pretty nice green shoots in the rental world coming forward. Chris, what's your takeaway?
Yeah, I would echo a lot of what Zach just said. I think there's good reason to be optimistic. I think we're still in a housing shortage in America, both for sale and for rent. We need to be building more housing. But at the same time, we're in a very healthy rental market for the consumer right now. As I mentioned, rent to income ratios are in better shape for the consumer than they've been in quite a while. And the rental market, whether it's BTR or apartments, is filling a needed void right now. And so I think there's room for owners and operators to drive rents and to be successful in their business. There's still an affordability opportunity in the rental market for consumers to rent. And so I think as long as we look at kind of the long-term trajectory of this industry, see the need for continued development, see the need for continued building, and that's from the municipal level as well. Allowing for multifamily, allowing for BTR to be built in our communities, and to allow those renters to live where they want. Yeah. I think that's crucial. And I am also optimistic that that's going to happen.
That's a great point. It never ceases to amaze me that there is antagonism, political antagonism, and kind of NIMBY antagonism to BTR. It just makes absolutely no sense to me. You're adding units of supply to the market. Good Lord.
And BTR is often maintained a lot better than owner-occupied homes.
Yeah, it's nuts. I don't want to be Dean Downer here, but I think the thing that we still need and is kind of missing is capital. And capital is going to need to see interest rates start to come down a little bit to really kind of become re-engaged with the market. Don't you think?
I do. I think where interest rates are today remains prohibitive for a lot of the capital to come into the market. At the same time, where interest rates are today and where mortgage rates are today, that's going to keep people renting for longer.
Yeah.
And as that demand stays elevated, I think you could see a lot of multifamily capital recognize that and say, you know what, to Zach's point, now is a good time to put my shovel in the ground, because if I'm breaking ground on July 29th of 2025, it delivers July 29th of 2027, we're going to be in a much different place.
Yeah, I love it. It's fluid. There's a ton of moving parts. That's why we do what we do. It's fun. Zach, Chris, thank you guys so much for coming on the show. Really appreciate it.
Thanks for having
Dean.
us.
Right on. This is Dean Wehrli for the New Home Insights podcast. We'll see you again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly Building Market Intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbrec.com/subscribe and signing up.